Hello everyone and welcome to Jim Dalton's presentation on pre-opening comments in the first hour of trade. It's June 18th, 9:15 a.m. Eastern. We'll go till about 10:30 a.m. As we know today, just for context, the FOMC will be, the chairperson will be making an announcement at 2 p.m. Eastern or around there. And as always, this webinar is being recorded and we welcome your questions in the box. And if we can't get to it, please correspond or call us so we can get your questions answered. And with that, we will hand it over to Mr. Jim Dalton.
Well, good morning. I threw a crude oil chart up here to begin with, simply because it was an interesting point. I don't know who it was, but I did see an email from someone, and they asked if we were going to be talking about crude this morning. Of course, the answer would be no, but I couldn't resist it, and the reason they wanted to know is they went home with a position last night. I don't remember if it was long or short.
Long.
It was long. But my point is, when you've got a market that is in a 3-day balance like this, and the market, settles down here near the lows, if you're doing a short-term trade, I see no advantage to taking a position home overnight. It doesn't make any difference if it's bonds, crude oil, S&Ps. If they went home long, it's up a little bit this morning, but it's just one of those things that doesn't make a lot of sense. And you're in a balanced market, and again, if you're in a longer-term trade, maybe you have different reasons. But anyhow, I just for the second, when you see something that's within balance, I like to go home flat, and because from balance you can either stay within balance, break out, in this case, break out of balance to the downside, or look below the downside and fail. And I would rather be fresh in the morning, having no position, rather than coming in with a position. Okay. Just one second.
And Jim, while you're doing that, I didn't say, but a really heartfelt thank you to everyone for being here. Jim and I really enjoy having you, and it's wonderful to have the opportunity to share Jim's work. And we know you all have very busy lives and trading to do and all the rest. So thank you all for being here. And that's it.
Okay, thank you. I think Julia sent out both the recap and preparation report, which is the report we do every evening for the following day, as well as the morning report, which just gives an update from anything that has happened overnight. So we're back to the S&Ps, and let's take a look at the profiles. As you can see, we're on the profiles. We have an all-time excess high. We have a small distribution that makes up one day below the excess high and one day below it. Then the market broke to the downside, and you can see didn't break very far, and now it has been one time framing. And what one time framing means, this would be the 13th. The low on the 13th did not take out the low on the 12th. The low on the 16th did not take out the low on the 12th. One time frame. So each new day, the low did not take out the previous low. So the market is what we call one time framing higher. On a short-term basis, that's very significant. So where we are right now is we've got, as I look at this, I see very poorly defined, but I see one distribution above this poor high at 1937.75. And if I take another distribution, it goes from the 1937.75 level down to the low here on 1917.50. But more significant, what I'm looking at is the breakout from this area right here, which was 1916.25. So as we get ready, let me bring this back into place and give it a chance to settle. what we're looking at, we have a very poor high from yesterday, and we have a very poor high going back to 6/11. So we have two very poor highs. The first book I wrote, Mind Over Markets, the first book, edition 1, really talked about buying and selling tails. As many of you know, it took me some time to figure out the significance of when there wasn't a buying or selling tail. The significance of having no buying or selling tail very often is that the market is too long. So in this case, we have a very poor high, and that very poor high can mean a couple of things. It can mean that the current auction is not completed, or it can mean that the market was too long. Sometimes we say a market is too long to go any higher, at least right now, so you have to sell, and the saying goes, you have to sell before you can rally. In other words, you have to break before you can rally. So there's a lot of weak longs up here. Then they have to shake those weak longs out, and we get a pretty good liquidation break, as you see the following day, which would be 6/12, quite a liquidation break, which got rid of the weak longs. They get replaced by newer, fresher longs, and as you can see, the market then starts to one time frame higher once again. Now, the third thing, so we said one can be that the auction is not completed when we're looking at this at the high up here at 1937.75. One, that the market has not auction has not been completed. Two, that the market is too long and the market needs to break before it can rally. Or it can be a combination of both. And the combination with both will be the market is too long in the shorter time frames to rally, but the auction in the next higher time frame has not yet been completed. And so that may be what this was, and you see we've now come back up near those highs. Yesterday, we have another very poor high. So again, what we don't know is the market too short in the very short time frame and not completed in the longer time frame? Does this market have to break before it can rally again? As we get prepared for the opening this morning, that is a question that we don't know. When I look at yesterday confused a lot of people, and the report I wrote up last night, I said I managed to get whipsawed yesterday, which normally doesn't happen to me, but I did. I came in, I wanted to be long. I wanted to be long in the morning, and because I really thought the market was going higher. And the first clue that we were going higher was when yesterday's market did not take out the low from the previous day. And when that doesn't, when you don't take out that low, you're going to have, it's going to be very difficult to have the market go much lower. So the market did rally. The market broke twice and came exactly to the opening. The green dot that you see is the opening. So it came exactly to the opening. When I see a market go exactly to the opening and rally, I have a pretty good idea that it's nothing but daytime frame traders. Longer time frames don't wait for the exact opening price. Remember what we've talked about so often, is understanding what time frame is in control of the market that you are currently trading. And the reason for understanding that is that each of those will have different behavior patterns. When the day or daytime frame or short time frame are in control, the references that they will use will be the previous day's high and low. They'll be the opening. It'll be unchanged. It'll be half back. It'll be previous highs and lows. And when this comes down yesterday morning twice exactly to the opening, that tells me that I have day time frame or short-term traders active in the market. More than likely, I do not have any indication of any significant participation by the longer time frames. So the market, again, you will see in the afternoon, the market went to F, G, H, I, J, K is up here, L, M. I mean, basically, this is the behavior of very short time frame. Just buying, with one exception, Cape Period, with buying, one tick off of a previous low. That is very mechanical type of behavior. That is the behavior that could be expected from shorter time frames. Also, I doubt if you're using 15-minute bars or shorter, you probably will not see these patterns. That's the reason I have used 30-minute bars only over the years, is it gives me a better perspective of what is really going on and who is in control of the market. Also, if a market's one time framing, you won't see that on the shorter bars. So as we prepare for the opening 4 minutes today, I'm looking at this very poor hum yesterday. I'm looking at the distribution, and I'm going to take that distribution, that upper distribution yesterday, and I'm going to call it from the 1931 up to the high, and I'm looking at that as a separate distribution because that's where the market spent most of the time trading yesterday afternoon. If the market stays above this distribution, that's very positive, at least in the day time frame. If there's to be any change, we get down below the 1931 level, which is the low of this upper distribution. Going down below, getting down below here, and without any great follow-through, is probably an indication of some short-term liquidation rather than anything more significant. To have anything more significant, I would like to see the market down below yesterday's low, stop this one time framing mode, and which would indicate we stop one time framing, value would start to build lower, and we'd have an indication of greater change. But if all we do is stay above the low of this upper distribution, more than likely there's no change as the market opens this morning. Okay, we got just a couple of questions prior to the opening.
Thank you, sir. Yes, does Jim look at the two poor highs, one from last Wednesday and yesterday's high, as exponential probability for the market to go higher versus, just having one poor high from yesterday, say?
Yeah, there's more significance with two than there is at one, but I'm a little cautious because they're not good highs. Neither one of them are good highs. But today we've got a Fed report coming this afternoon. It was very unlikely yesterday we would have any longer-term money in the market, and the big event is going to be this afternoon. Now the market, so I do not think these are very good highs. They do not look completed, but remember I said there can be a possibility that the market's just too long. So I'm going to start by worrying about this right now. I'm going to take it one step at a time, and I'm going to concentrate on this upper distribution. I'm going to treat this upper distribution as a separate day or auction. So we could look above it and fail. We could stay within it. We could trade lower. Okay, another question.
Great. Thank you, Jim. Regarding you, this is an intensive enrollee. She's asking about yesterday's report for the ES pit session. You wrote that value development above the prominent point of control from Monday will be a sign for the market's direction to be up. The first double print, A and B, was printed above the point of control. Could this AB be seen as a sign of possible value development above the point of control that justified a long trade with the target of Monday's high? Or is there generally more acceptance, in other words, time periods, needed when we want to consider it as value development, higher value, observation when we make that determination?
Yeah, there's not a simple answer to that question because yesterday it was very confidence was very low yesterday. We went back and forth through the opening. We rallied. It was a weak market, low confidence yesterday, and value was actually building lower until later in the afternoon. So what I was concentrating more on yesterday was the fact that this low was not taken out, and then I was concentrating on the high from the previous day. But
Great.
So it's not as simple as the question. I understand the question. It's not as simple as that because of the lack of confidence yesterday. Okay, we'll come back to more questions in a minute. The market is open. We are still within the overnight range. Earlier I was talking about day time frame references, and they're, the opening, they're unchanged, etc. And the overnight high and low are also constant daytime frame trading references. Do we find acceptance or rejection above the overnight highs and lows? So right now we've gone up. We've tagged. Looked to me like we've tagged yesterday's high, one tick above the overnight, high, and you can see what was going on. As soon as it got to the overnight high and yesterday's high, there was mechanical short-term selling. Again, if there was longer time frame in there, more than likely that wouldn't happen. Whose behavior would sell exactly at yesterday's high or exactly one tick above the overnight high? That's short time frame traders. That is not an indication of longer time frame participation in the market. It's very mechanical trading. They sold exactly at yesterday's high. They brought it right back down. You can see the last trade, I think we traded exactly at the opening. That is a very common day time frame trade. Unless there's some rumor going on out here, I wouldn't expect to see any longer term money really have interest in here unless somebody's got some word that the Fed's doing something unusual. So right now you're getting, you've seen this morning, very mechanical reaction. Look at the overnight high, yesterday's high, and just people waiting mechanically there to sell it. And I've talked many times when I've done in the past programs for floor traders, and some of them were X. This was after the time of floor trade. You would see that they would automatically buy and sell at previous day's high and low. It's just a mechanical type of thing. It's the behavior of very short-term traders. And as I've said so often, if those out there among you that want to act that way, and that's fine, but you have to understand, if you sell automatically at yesterday's high, you have to be very quick to reverse that trade if it doesn't work, because those are the trades that can come back very quickly. Okay, so now what we did, we looked at the overnight high. Now they got back through the mechanical, the opening. Now what are they looking at? Now they're looking to see if they can get to the overnight low. Again, very mechanical trading. It's the behavior of very short-term traders. Now, we talked about yesterday was a poor high, having traded there exactly today. That makes this high even more suspect.
Because of the common, now we have two highs matching on a day time frame, daily bar.
Plus, this was a poor high to begin with, so if you pull the A period over and make this one profile, it would be JMA, IJKMA, but that is a poor high. It's a even poorer high, but again, that doesn't negate that we get some liquidation in here, because the market was very long yesterday, and I'm looking at how mechanical this was all yesterday afternoon. So right now they're looking at the overnight. They failed at the overnight high just above, and now trading down, looking at the overnight low. Very mechanical trading so far. Remember, this can indicate the poor high can also indicate a market that is too long. So you have the potential for liquidation in here. All right, questions?
Great. Would it be fair to say that your observation about short-term traders being in the market yesterday suggests that and you're saying it for today so far, I think, suggests that the larger players have sidelined themselves prior to the FOMC announcement this afternoon?
Yeah, I think the larger players have been sidelined for some period of time, as evidenced by the volume. Again, yesterday was 2.8. I mean, we got it. I mean, we've had very, very low volume. I think mostly this market has been, you know, it's just the trend is there. The trend is feeding on itself. There's a sense out there that everything's going to be fine. One of the concerns I wrote in the report last night is that, you know, it's unlikely that the Fed will do anything. And historically, when we see, you know, we see some volatility after the Fed report, but you know, a couple of days later, everything's back to normal. There is, however, every now and then, and it's only maybe 1 out of 10, 1 out of 15 times, there will be some kind of significant change. And one of the things that has got my attention is there was a Fed report, I think it was out of the Texas Fed or whatever that is down there. I forget the exact name of it.
Dallas and New York Fed, too, I think.
And a report, and there's also Fed people talking about, you know, the complacency in the market. You know, I think we're at like 15 and 20-year lows on volatility, and there's some discussion that low volatility sometimes it indicates that the traders out there are too complacent, and when they're too complacent, it means they take too much risk, and this is how asset bubbles get created. You know, we've got the Fed put $1 trillion. This is a manipulated market. It's nothing's ever been done to this extent, so we don't know the final outcome. But we do know that the volatility is exceptionally low. We know that the fear factor is very low, as evidenced by, it was interesting, I wrote something a few days ago on one of the reports, and it was just because there's all kind of geopolitical negative news, don't let that override your ability to look at market-generated information, because the market really wasn't paying any attention whatsoever to the geopolitical news, which is very indicative of a market that has no fear and no respect for anything. They just think everything's going to be rosy. This is very often where we have problems that develop in a market. In the 1987 crash, which was, the odds are it should have never happened in our lifetime. I think the Dow was down, what, 2,500 points or something. It came out of a place where the market was extremely complacent. The market was just up day after day, short, choppy days, no real volume, and that's really where these kind of problems occur. So I don't know if we're going to get anything today, but they have at least talked about it. It would be unlikely that they would do anything, but it's not beyond the realm of possibility that they send a warning to the market not to be too complacent. So I'm aware of that, but it's certainly not something that you want to bet on. Okay, look back to this market. We went 1 tick above the overnight high. We went 1 tick below the overnight low. Again, you get a sense.
1 tick above the overnight low. We did not take the overnight low.
I'm sorry, 1 tick above the overnight high, 1 tick above the overnight low. So you see
yes,
how mechanical this market is trading this morning. All this is short-term money just going back and forth, as we say, picking each other's pockets. Okay, additional questions, observations?
Yes, thank you, Jim. Very briefly, the colors on the window trader blue here, white is very light volume. You see as it took out the overnight high, there were 138 contracts traded, as opposed to red being the heavy volume. Right there at the volume point of control, 10,000 in the middle there at half back with the white line, and pink being moderate or medium volume. So that's all those colors are.
And you can make them. You can, you can make this. You can make them any color you want. You can do anything you want.
Yeah, you don't need to. Yeah.
Okay.
Early on in the morning, do you pay more attention to where the point of control is forming or migrating, or where the value is developing relative to yesterday's value? Yesterday in the pit session, the point of control was migrating higher before the value started developing higher.
Well, I'm always. Let me come at the question from my own way. The first thing I pay attention to in the morning is, what is the level of confidence? Is the level of confidence high or low? So yesterday, the level of confidence was low yesterday. Then the market started to rally, and early on, it looked like the market could have overlapping to lower value. It took quite a while before, late in the afternoon, before it was clear that we were going to be able to get overlapping to higher value. What I paid more attention to yesterday, I was focusing on, one, that we did not take out the previous day's low. It's a continuous two-way auction process. If we auction down an A period, we don't take out the previous day's low, where's the next auction going to be? It's going to be to the upside. And then it takes time to develop. But when we came back down the second time and traded exactly at the open, the market basically, it stopped one time a couple times, but it basically one time framed higher most of the day. And that became the more significant observation. Let me collapse this for a second. So once the market came back down to D period, then it became fairly clear where the POC was going to be. But what was more important on a day time frame basis, E did not take out D, F did not take out, E, G, H, I, J, and you didn't stop one time framing until L period, which, as you know, is very common, because this was a trend day. This was a trend day following the D period low. It's very common on a trend day to have the market stop one time framing in order to allow inventory to come back into balance. And that's basically what happened. So yes, value overall was higher, overlapping to higher. Yes, the point of control did move up, but it wasn't clear early on. So anyhow, it's not a clear answer to your question because there was other considerations in there, and it was fairly late in the day before we knew the value was going to be overlapping to higher. Okay, now what's happened now? Remember, the first time we went up, we went exactly to yesterday's high, traded off. And we said, who was that? Who would sell at that level? It's going to be automatic daytime frame selling. They went down and they took the market one tick short of taking out the overnight low. So the continuous two-way auction process, what are they going to do? The next auction is going to be to the upside. They went up to the upside to get the, and they got the stops that were above the yesterday's high and above the early morning high. We said that by trading exactly at that level the first time, that made this high much more suspect and much more likely to be taken out. Okay, and that's exactly what the market did on a very short-term basis. Now it looked above yesterday's high and it came back in. Again, all I see in here is short-term money trading back and forth this morning, just investigating, anything up, anything higher, anything lower. Now that we've looked above yesterday's high and come back in, the next thing they're going to be looking at is going to be the white line here is half back. Half back, and you can see this last break took one tick above half back. Half back is a very common day time frame trading reference. You see it went to half back, they automatically bought it, and if we get down below half back and to the opening, and then the odds are you got a little bit of a sell-off in here. But these are the kind of markets that are very difficult for most traders to trade. They get chopped up. This is where the where the chop comes from. So I generally make a recommendation, unless there is high confidence surrounding the opening. If you are a newer trader or a trader who's been trading for some time, but if you've done some analysis and you say a lot of the pain, financial pain, comes during the opening hour or so, then unless there's high confidence from the opening, step back and let that market settle. Because low confidence markets, they just go up and down, and they can just chop you to pieces.
Well, on the heels of that comment, sir, we have a question from Chicago. What do you think of, or I should say Minnesota, I forget you're out there. What do you think about a short here at yesterday's high now that we have went above it twice with no action?
I'm assuming that's from Brent?
Yes, sir.
So I don't have any interest in a short up there at this point. It doesn't mean it doesn't work. And I know you guys are very short-term traders. Like I said, when it looks above yesterday's high and comes back in, and like I say, if you are a short-term trader, there's absolutely nothing wrong with that trade. But the caveat is that you are mentally flexible and you understand, unless you get follow through fairly quickly, you want to get out of that trade. So it's, again, to some traders it's a great trade. The way you trade, that's probably a good trade, because you know that you have to get out very quickly if it doesn't work. Remember, it is against the trend. Value so far is developing higher. When value is developing higher, you're against the trend. If you have to be right very quickly. So if you did that short, first you need to come back into yesterday's range. You need to find acceptance below half back. Then you need to get through the the opening, through the opening, and then take out the overnight low and start to extend. So again, it's one of those trades. It depends upon how quick you are to change your mind. Okay?
And how quick you are to get in, because obviously, if you got in up here, you structurally have a place to put a stop that's pretty tight. You get in there half back, you got a little more pain.
This market went exactly to half back and started back up again. When I look at a market like this, it's not a trade that I have an interest in. I would rather be, if I'm going to go against the trend, I would rather be a little bit later than a little bit early in there. And like I say, mechanically, it went to half back, and they were buying it again in half back. Low confidence, all short-term money. But again, so much depends on mentally how quick are you to be able to reverse or come out of a trade. If you're going to short this thing, as soon as it stalls at half back, that's a danger point. You got to remember, we're against the trend, and we have another poor high up here at the 1937.75 level.
Do you want to collapse your profile from yesterday just to make that chart so we can see the Wednesday's high? Well, you're going to have to hit cancel anyway. Yeah, thank you. Great. Okay. Thanks. We have a couple of, go ahead, please.
As you see,
go ahead.
So the question about shorting above there. So mechanical short, as you can see, it's against the trend. You have to be right very quickly. Value's developing higher. It went exactly to half back. And that's, again, those are the trades you have to act on fairly quickly. Okay, I'm sorry, you have a couple more questions there?
Well, we have some questions on confidence, and one way to say it, can you speak to the indicators of early confidence around the open, what you're looking at? And I'll put this one in. Does Jim have a minimum amount I'm sorry, how do you discern high or low confidence? Is it by volume or by range in the first period or after the first hour, or as he's referring to it, initial balance? You certainly wouldn't have to wait that long.
It's through observation. I know that's not a great answer, but you know, when you've traded for a while, you take a look at the opening and you start to ask yourself, how much confidence is there surrounding the opening? For this morning, we opened, we went back and forth through the opening. We came back to the opening, we went below. What is the confidence level? It's low. You know, there's no set formula for this. It is something that you gain via experience. And it's like, you know, going golf, you can take all the golf lessons in the world, but until you get the feel of what a right shot looks like, you know, you really don't understand, oh, I finally know what it feels like. Confidence, you start off the idea and say, okay, if I'm back and forth through the opening a couple of times, you start to say confidence is relatively low. Okay, take the other extreme. I open and I drive directionally, you know, right away. Well, confidence is relatively high. Then you say, okay, if confidence, say the market's going up and confidence is high, you start to say, okay, I would expect to see the market elongate out, and I would start to see it give very little give back, you know, when the market does settle back. But confidence it's one of those things that you just have to observe over time, and because without that, you're not going to get the personal confidence to act on it and to use it to your, you know, to your advantage. There's all kinds. Yesterday, for example, we were back and forth through the opening yesterday, but I said I wanted to be long. So confidence wasn't high early on. However, I skipped and I said, well, let's take confidence one step further. The fact that we didn't take out the low from the previous day gave me a pretty good idea that I didn't have any real sellers in there. So that's kind of looking one step beyond the day time frame confidence. The daytime confidence was low yesterday from the opening bell, and guess what happened? We got substantial volatility early on in the morning. As I wrote up in the report, you know, I got whipsawed a little bit yesterday because of that low confidence. I got a little bit, I got long, I was right early, and I was okay, and then they caught me on the second break. I thought that shouldn't have happened. But again, where did I get whipsawed? I got whipsawed because I was trading in a low confidence market. It was low confidence early on, and that's where it comes from. But today, we've been back and forth. This is low confidence today. No real carry through from, you know, twice now we've been above yesterday's high. Twice we've come back in. No confidence from the early bell. So again, it's just something that you have to develop over time. Okay?
Yes, and even now, look at how it's gone above the overnight high back in, now the pit session high back in. The confidence is, and clearly the FOMC makes everyone feel like they're in wait mode to some extent. But that's not to say the market can't get a directional feel to it, and momentum traders pile on and other traders just go with the green or the red signal. But we have a question here, Jim. Can you expand on the high volume node just underneath yesterday's high? And I mean, clearly we would say that volume, it's not proving to be selling right now. If the market were to come through it, yes. These three nodes, yes.
Yeah. Well, you can expect there will be high volume at the overnight high and at yesterday's high. They're very recognizable. They're very recognizable points, and I would expect volume to be high in that level.
Yeah, and it is compelling, though. I mean, it is markedly higher than normal. So if the price can't get back through it and chew through that volume, value is higher. We got the Wednesday structure of the poor high. It doesn't bode well for someone in a short. I mean, right, Jim? That can act as a support in its own right as a heavy volume node where it's hard to chew through.
But you understand, there also can be a lot of trade going on this morning with people hedging themselves with options and stuff for this afternoon. So you can get misled a little bit by this on a day like this. I mean, it's a low confidence day. It's a low confidence day so far. Granted, we got high volume here. If we were to come back through this volume and back through halfway, then this could pull it over on itself. But I'm not reading too much. It's certainly not selling. It's certainly not selling yet.
No, you can feel it.
Or we would be, you know, if that was all sell volume, we'd be substantially lower.
By now.
Okay. Yes.
Yeah, and again, it's just to...
But again, it's still, confidence is low. Remember, we've been back and forth above yesterday's high. We've been back and forth for the overnight high. Confidence is low, but this market has belonged to the buyers.
And it's also important just to say it out loud that, you know, it's one data point. We're looking at multiple observations, and I would say, Mr. Dalton, would you agree that the confidence is really your ruling or more higher priority observation right now, that don't get whipped, and until this market makes a move, you don't have any interest. And the volume is just one data point, along with many other things.
That's one thing. Back and forth through yesterday's high is an indication that there's you know, nobody came in and really started to buy it above that level. There are no sellers to speak, but if confidence is low, and when confidence is low, anything can happen, because you can get, you know, you can get liquidation at a moment's notice. You can go up. Remember, we've got this poor high up here at the 1937.75 level. You know, I would think that the market would, you know, once, if you don't get selling in here, you didn't get back in, what's the next visible reference? It's going to be at that high up there. And I think that's probably what they're shooting for.
Yeah.
Okay.
Hold on one second.
So remember, we said confidence is low, but value is building higher. Value is building higher. This market, all trends are up. So, you know, they're not, you know, unless somebody comes out of the woodwork and really starts to sell in this market. But be very careful. It's very long from yesterday. It's very long. It's very long overall. There's just no selling. There's no fear in this market.
Okay. And Jim, we are still in the lower portion of last week's range. You know, when he's making the comment that last week was a market where we went from too long to too short in the day time frame. And now we are somewhat neutral. He's curious if
okay, here's the weekly. That's daily. Okay, so we have there's last week's range. So we're in last week's range, but you know, we're one time framing higher. 1, 2, 3, the gap 4, 5, 6, 7. We're one time framing higher. What I wrote, I think coming into last Friday, and I think what I wrote over the weekend, you know, unless you stop one time framing on a weekly basis, and the way we closed Friday, it was unlikely we were going to get that. So far, we're still one time framing higher on the weekly basis. We're one time framing higher on a daily basis. You know, you don't fight those trends. Yes, we're still this week is still within last week's range, but the weekly is one time framing higher, the daily is one time framing higher, the monthly is one time framing higher. So remember, all trends are to the upside. But let me take a second. Julia, do you have that? Can you put that chart up that you made for me this morning?
sure. Can you see it?
No, not yet. I can't.
Can you see it now?
There, I can. Okay, I do. Okay.
I guess I spelled that wrong. Fuselage. It must be with an E. Anyway, go ahead.
Okay. I don't know if I can recommend this book yet or not. It's How Not to Be Wrong, and the subtitle is The Power of Mathematical Thinking. Now that's enough to scare most people, but it really, we use math all the time. For example, you think, oh, I hate math, I don't want anything to do with math. But just a simple thing, if you go into the airport, you make some calculations about what time do you have to leave your house in order to get to the airport, what might the traffic be. You're making those calculations all the time. And when you're talking about odds, one of the things we've said is that most people in trading, it's constantly trying to understand what the odds are so you know how much risk you're taking. And those odds are never exact. The example I use so often is that people will say, well, Jim, exactly what are those odds? And then they'll say, if you can't tell me what the odds are, then scientifically that's not of validity. And I say, well, I know that driving on ice is a lot more dangerous than driving on dry pavement, even though I don't know the exact odds. But I don't need to know the exact odds. But the point I want to make here is that so many times, and it ties into something else I've said, and so many times what doesn't happen is very often as important or more important than what did happen. And it's a way of thinking. If somebody asked me today, if you ask me what did the market do today, everybody that's following the market they can tell you what the market's doing. The professional trader will look at you and what he'll go through his mind is what didn't happen today. And sometimes that is extremely important. Now, the example I want to have here, and it's just a minor example, but it's just, it was one of those ways that kind of shocks your thinking about how you look at markets or how you look at anything. This took place during World War II, and they were working on a problem. All these planes are going up, these fighter planes and bomber planes going up, and when they come back, they're riddled with bullets, and they're asking the mathematicians, they're asking the scientific research group. I want to say they were in New York or Boston, asking, what can they do in order to increase the odds that their planes and their pilots will come back alive. So the Air Force had collected all of these numbers from the planes that came back in, and they found in the engines bullets per square foot 1.1, in the fuselage 1.73, fuel system 1.55, and the rest of the plane 1.8. So they were providing this information. They were providing this information to help the mathematicians, and the thought was, let's see if we can put some armor on these planes. And the idea was, well, if you put too much armor, the plane can't fly. Put too much armor, plane, it's heavier, it takes more fuel, can't go the same distance. So the mathematical question was, where should the armor, I don't know what just came up here, where should they put the armor on the plane? Does anybody know the answer? Does anybody know the answer or read this? And tell Julie if you know the answer. Where should the armor go? Anybody answering, Julia?
Not yet.
Okay. Anybody venturing out? Where
under the pilot seat, fuel. That's funny.
Okay.
Fuel system, the engine, around the pilot, fuel system, system.
Who said the engine? Okay, the person that said the engine, why did you say the engine?
Eric? Yeah, and there's several people that are saying the engine. No.
Okay.
Everybody has a sense of humor. That's very funny,
okay.
guys.
Okay.
Okay.
The answer was the engine. And the reason the answer was the engine, and it was the fact that the information they collected here was the information that they had from the planes that returned. But it never accounted for the planes that didn't return. And why didn't the planes that didn't return? Probably because they were hitting the engine. So, you know, if this was just logical thinking, and it was totally against any of the Air Force that supplied these figures, thought they were really being helpful, but they hadn't thought about the planes that they only took what they could see right in front of them. They didn't consider the planes that didn't come back, because they didn't know for sure, so they're just taking what information that they have. And it goes back to the point that I've made so many times. Sometimes what doesn't happen is more important than what actually does happen. But the point is, it's a way of thinking. I don't know if that confused or helped anybody, but Julia, let's go back to let me have control back and go back to my my screen and see what's going on here.
Yep. You should have it.
Okay, let me know when you can.
And that, in a way, could be this morning, too. Well, you know, someone said we didn't take out the overnight low yesterday either by 1 or 2 ticks. You know, it didn't happen. So, but obviously maybe that's not it for today since we're coming back through, but it's an example of what could be.
Okay, now one more time, we've left the poor high again. Remember what I said when I wrote the first book, Mind Over Markets. All I considered was, if I didn't have a buying or selling tail, I considered the odds were really good that the market was going higher. It took me several months, and maybe a couple of years, and as I've said to people, probably $250,000 that I either didn't make or lost, over-relying on the information that was right in front of me and not considering other possibilities. In the second edition to Mind Over Markets, which came out about a year ago, some people say, well, there's only one new chapter. There is one new chapter in the book. It's on expert. And in that new chapter, one of the things that I cover is the lack of a buying or selling tail, what we've been talking about this morning, sometimes is the most important information because it's telling me that the market may be too long. We saw that right here. I was able to make money on the downside. I was able to overlook the lack of a selling tail here simply because I knew there was another possibility or consideration, and it gave me a pretty good trade to the downside. On the break, I also recognized on the break that this was mostly liquidation, not a combination of something that was more potent of liquidation and new money selling. But combining this poor high with the liquidation, I said, okay, that's all I had. And see, I didn't get elongation in this market. I didn't get a lot of volume. So I said it's probably liquidation, and that probably what was needed to get some of the weak longs out of the way before the market can rally. And then the market turned around and rallied again. Now I'm facing that same question again with a poor high today and a poor high yesterday and another poor high today. And remember, this is combined with the low confidence this morning. Am I looking one more time at a situation where the market is too long? Let me split this out one more time. Okay, so again, I know, and you say how? Through experience. This is week long. These are all week longs here. When it's common to buy, one tick in most cases, with the exception of Cape Fear, one tick short of a prior 30-day high or low.
30-minute.
That's not 30-minute high or low. That's short-term money trading. That's not high confidence longer money. This is the kind of situation that leads to inventory being too long. So one more time, we've looked up above. Everybody, the enthusiasm is to buy, buy, buy. That's been the easiest direction. They tried to take it again this morning, and I think they just got longer and longer. So long from yesterday, a little bit long from overnight, long again this morning, and now what are you seeing? Liquidation. Remember I said early on, confidence was very low. When the confidence is low, you are best off just to sit out the market, because you're likely to get very chopped up. It's been very easy to get long this morning. Headed for this high up here. Again, it came a couple ticks short. Low confidence markets will chop you up pretty quickly. Now, one more time, we're looking at the overnight low. Julia, your lips are moving. You have a question.
Well, yes, and also you said many times too that poor highs and lows are very often seen with the day and short-term traders dominating, because they fade constantly and they sell highs, buy lows. So it's also indicative of the environment we're seeing today.
Yes.
With the people we're competing with. Okay, what's the difference when a poor high or low is made with or against the longer-term trend? Is there any significance?
Not necessarily. Usually poor highs and poor lows are very, well, there's two things. One, it's just an auction that's not completed, and it may be completed later in the day, or it's just inventory got too long or too short. And we've seen constantly in these recent markets inventory getting too long, too short, too long, too short. We see days where there's three good trades, three good moves throughout the day. They're all related to inventory. Obviously, with the trend, you're always better to trade with the trend, in there. So but again, usually poor highs and poor lows are usually related to short. They're usually related to very short-term inventory being too long or too high, and they generally do not involve the other time frames. They may indicate a lack of other time frame participation, like this morning. Low confidence, another poor high yesterday. I think we have a lack of longer time frame participation, but we've got a lot of enthusiasm on the short term traders. Now, one more thing. Let me mark something. Mechanically, this market, there's unchanged from yesterday. The market broke to one tick below unchanged, and did not take out the low. And as soon as it went to unchanged, one tick below, then they were buying it again. Again, all very short-term references, all very, very difficult periods to trade. The more difficult thing in here, so many times for traders, is to keep your hands off of the click, the mouse that buys and sells. How many people have traded this morning? I mean, I don't know. We can't get an exact count, but just take a second and just say yes. Just give Julie a series of yeses if you've traded this morning. Julie, let me know if you get many answers.
Overtraded, yes, no, yes,
not overtraded.
No, yes, 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 yes. Many yeses, and several no's too. It's looking like pretty 50-50.
Okay. Of those that have traded, how many have done more than one trade? Just say yes if you've done more than one trade.
Yeah. There's a lot of, now there's only one person saying no.
Okay.
Well, here's another one with one trade. But it gets addictive when you get into that mode, or at least for me, I've struggled with that. I've let it go now, though. Yes. So a few people are saying one trade, so it's, but the majority have said more than one if they traded.
If they traded, and that's really, and my guess is, if you got any profit, you're lucky if you have profits after you take out transaction costs, and you're probably mentally exhausted. You've already taken a lot of that, and the big activity may come this afternoon. Again, a lot of times, I mean, people can come to these courses and the webinars and everything else, and unless you start taking control of your emotions, it's very hard. If you're taking a low confidence environment like this morning, and you can't resist the trade, and you feel that impulse, oh, this may be the big trade, we may be going to that high, well, I don't want to miss this, well, I can get in and get out, and you know, and if you take a look and see if that's successful for you, fine. If it's not successful for you, then you've got to work on leaving your hands off of the mouse until you get a high confidence trade. And like I said yesterday, you know, I made a comment for those who get the recap and preparation report. I went through the day before, and I made a comment at the end that I traded more than I usually do. I had a superb day the day before. I read the market, you know, perfectly, and I'd be lying if I didn't say I came in, you know, a little bit excited about yesterday. You know, because it was just a superb day the day before. I think, if I remember right, I think I was right on 6 out of 7. Very profitable day, and I was geared for that yesterday. And what did I do yesterday? I got whipsawed. I traded in the market. I was okay. I didn't get out. One place where I always tell you to get out, that's the high risk. That's the high risk trade, and wrote it down and finally got stopped out. But you know, there's so much to do with staying out of bad markets and low confidence environments. If you can stay away from the low confidence environments, which is very hard because you think, well, this time's different. But we talked about low confidence from the beginning today. There was nothing, the word high confidence never came out of my mouth. Low confidence from the beginning. People ask, well, what is confidence? And you know, said, well, this is low. Back and forth through the opening. One tick shy of the overnight low. Above the overnight high, above yesterday's high. Back into the range. Very low confidence. Great environments to stay away from. Okay, I hope I beat that to death enough.
No, it's we can't hear that enough. I mean, we all have fallen into it, I think, if we were honest with ourselves. Jim, about yesterday, and maybe you could talk about that early trade you did, but Brent is asking, can you tell us some of the bad trades yesterday so we can learn from them? And it was interesting because Jim said to me, I got so angry, or you know, I got stopped. I knew the market was going higher, and I got stopped out. I can't tell you, I really have not heard him say that over 5 years. What, maybe, I don't know, maybe a couple of times. But it was interesting to hear him say that because it's just not what he does. But do you want to talk about that trade for Brent, Jim, in terms of the morning trade when it came through the open?
Yeah. The big thing, the big thing was really what caused the problem was not exiting. You see, the high was made in B period. And look at the high, the early high. Look at the high relative to the high from the previous day. Or this day, a high relative to here. It didn't get this high. We got one tick above this high. And how many times I say, when the market gets up into this level, you get out. That's the high risk. That's the high risk trade. And
yeah, if there's going to be a problem, it's going to happen there. So just get out, and you can put it back on the other side if it's such a great trade.
That's exactly right. And what I did is I got out the first time. I don't know if I remember exactly. I got out the first time. I think what happened, and I bought the break. I bought the break. I was a little bit late buying this break. After the C period break, stopped there. I was a little bit late buying it. It comes back up near the early morning high. And that's where I didn't get out. I'm remembering this right. And I'm sitting there and say, well, it's probably going to take it this time. And then it turns around and it starts to soften. it starts to soften, and then I stayed around, and I thought, well, that's probably all there is to it, and I think I bought another one, and then I got stopped out on this breakdown here. But it all started, I mean, I really hate to admit it, it all started by not getting out right here, because this was where, if there was going to be a problem, was where it was going to be, and then letting my emotions get involved a little bit, getting a little greedy, adding a little bit to the position just above half back, and then having the market, go all the way down and take me on. I thought, sure, it was going this way. And I actually took the trade, I believe I took the trade from long to short, and that's where the whipsaw came in. It was just emotions got to me, and it's just it's not something I do, but I know it was a lack of control from having had such a super day the day before. Now, there was nothing, the cost in here was nothing meaningful at all, and it was absolutely peanuts, but it was the emotional toll that it took, and it was the understanding that I had let my emotions go unchecked. I got a little bit greedy, and that kind of stuff happens. And what I did, I overlooked the fact that the confidence was low early on, and I knew the confidence was low. The low confidence early on tells me that I need to get out of this trade on the C period rally, or E period rally. I don't remember which one it was. It may have been after it broke, but I need to get out when it gets up near that low, because confidence is low. The market did exactly what it should have done to somebody that forgot about the level of confidence, or decided that this time was different. Okay, I don't know if that's any help or not, but I know the big thing, I know it started, as I go back and look at it, I know it started with having such a wonderful day the day before, knowing that I was invincible, and knowing that I was in touch with this market. I can do no wrong, and of course, we know what that leads to. Okay.
Yes, Jim, that's great, and people appreciate that honest, feedback, because it's just nice to hear, and how it happens even to people like you, and how we have to guard against it. And thank you for asking, Brent. Now,
the
go ahead,
situation,
sir.
let me stop. The situation is, which I've said before, you cannot trade a market without emotion. You can't make any decision that's meaningful without emotion. The key is how to corral that emotion so that it's balanced. You never make a decision without emotion, but the question is how to keep that emotion in check. And one of the things that I do to keep it in check is I keep a piece of paper next to where I trade, and I make notations. And I made these yesterday. I just didn't pay all the attention. So the first thing I put was, LC. I just wrote a big LC in the morning, low confidence. And I look at that, and I make value. In fact, early yesterday morning, I wrote value appears to be going to be overlapping to lower. And then later on, I see a notation here, value likely to be overlapping to higher. And I do things like that to keep in check. What you got to pay attention to it. That the low confidence yesterday morning is the driver of everything. Low confidence this morning has totally kept me out of this market. I've had no interest in being in this market under that low confidence conditions. Under low confidence, I'd rather be a little bit late than a little bit early. This is a very narrow base. If there's anything in here, it probably should be a double distribution date. Okay, I'm sorry, Julia, you were asking another question earlier.
Yes, thank you, Jim. I want to clear up Jeff here asking a question. It looks like value may be shifting lower with the volume point of control moving into yesterday's value area. Would Jim expect further exploration lower now based on this?
I see no indication so far. I see no indication so far that value is going to be lower. I just don't see it.
Right now, just so people can, it's very hard to see, but the shaded value area for today is really where the last price was. It's hard to see, but So when you compare that to the shaded area of yesterday, it's still higher value. Now he's looking at the volume point of control. It's coming into yesterday's value area, but really it's a more general observation how Jim uses it. So I wanted to clear that up.
Here's the top of yesterday's value, the red line. I'm going to now take it out. That's
not the top of value. Today's value, yes.
That's the top of today's value right there. This is the bottom of today's value so far. You know, and I'm not terribly concerned about the volume here at 10,000. It's just one tick above the opening. You know, I don't get too mechanical of this, and I do not build my value based on the volume. I build my value based on TPO. And the problem, as I said, it's really not one or the other. But the problem with the value, with using only the value area,
volume,
the volume, is that it doesn't bring time into effect. I like the combination of bringing time into effect. Markets, price advertises opportunity, time regulates all opportunity, and volume measures the success or failure. And when you're using only volume, it doesn't bring time into the equation. So right now value is building
overlapping to
higher, but the base is very narrow.
4 points.
Is very narrow.
Thank you, Leon.
Very unlikely that this will last. And so far, I see absolutely no trades this morning. I see absolutely no trades or any reason to be involved in a trade, with the exception of the question Brent asked earlier. When it looked above yesterday's high and came back in, and I said, that's fine as long as you are very quick to reverse. And the market went down. We saw that trade go down. It stalled immediately at half back, and then it rallied.
Right. Don't be married. Just get out. Yeah.
Yeah. That's you know, and if you don't have that kind of personality that can make those changes and those pretty quickly, then you shouldn't be doing really short-term trades. Okay.
And a question from one of our UK traders: I'm not very fast to close or reverse a trade. For that reason, it would probably be better to wait for liquidation then. He's asking. You know, he's looking for a bigger move because he can't, doing these fades for short moves, it's not his nature to just turn and reverse or get out. And yes, that's why it's hard when you're in a trade room and people are calling trades. It really depends on how do you trade. What is your propensity? What is your strength? What is your time frame? What is your capital? So,
and these people calling trades, it's just, it can be very misleading because, like I say, that it is very unlikely that any two people will have the same time frame, and that's not really going to give you the confidence. You're only going to get the confidence when you make the trades based upon what you see. And what we're trying to do here is teach you how to look and how to observe a market. Let's take some, as we're coming to the end of this session. You know, we don't have a high quality high from there, from here, going back over to the profile of the 11th. But we do have an all-time excess high. So the longer time frame, we all have an all-time excess high, and we're still a reasonable distance above it. The range this morning is very, very narrow. No real confidence on the high or the low. You can say, well, there's a buying tail down here, but it's one single tick above the overnight low. So I don't think there's anything I would, you know, I would be enthusiastic about.
It's hardly aggressive buying to really, yeah.
And there's absolutely no sign of sellers, Nobody, no longer-term money has come out of the woodwork and said, boy, this is a real opportunity to sell. Nobody seems concerned about the FOMC announcement. Very narrow range, and it's unlikely that this range will last for the day.
Very quickly, just to to explain the window trader blue chart here, the left-hand volume stack is all trades for the entire session. The second one to the right is the current 30-minute profile. Jim likes to see how that is building. Now, obviously, we're into C period, so we've got a new 30-minute current volume. So thanks for that.
Yeah, I like to see, I set it up, I like the cumulative, I like to see what's happening right now because I do a lot of short-term trades, and sometimes this will give me some indication that something has changed in the marketplace. Okay, final question?
There's so many.
Okay, well, I'll take a few more.
We can't explain how to set that up. I mean, not here, and I can't type it in. But you can talk with, email me after and I can send you a template what we use. That's the nice thing about Window Trader Blue. You can just share templates and you don't have to set anything up. If the VIX has risen, does that not say there is fear building in the market?
Yes, well, the VIX went down to under 10. The VIX went down to under 10 last week, which was, I think the lowest in, I want to say 20 years or something like that. And then I saw last time I looked yesterday, we were back up around, it looked to me like 12.5 plus. Where I just looked now, we're 1166, so it's off a point. But the VIX overall, historically, is very low. And so the VIX is saying that, what does the VIX say? Remember, the VIX is just an estimate of short-term volatility, 30-day volatility. And it's really developed for the VIX to go up. It's a lot of people buying puts, out there in the market. And so there's not a lot of people buying protection. There's not a lot of people concerned about the downside. And of course, that is what worries me. But right now the VIX is saying they're not concerned with the market. Very low volatility. They see very little risk in the market. That's what the VIX is saying over the next 30-day period. Remember, we've seen the VIX as high as 80% or so. And as low as under 10, and we're very near the low end. Volatility tends to decrease and then become cyclical and tend to start working on the increase. It's a very cyclical type of thing. But right now, it sees no fear. And my point is, that's when you should be afraid when no one is afraid. That's when you get the unexpected events that take place that trigger liquidation. And it is always amazing how fast a market can go from no fear to total fear. It is absolutely when you see it happen sometimes, you can't believe that 2 days ago they had no fear and today they think the world's coming to an end. I mean, that's how fast it changes sometimes. And and you get these unexpected events that come place. Right now, historically, anytime we had some of the geopolitical things that we've had over the past few days, the market would have at least sold off, and some caution, some people just go to the sideline just in case. Now everybody is so convinced that the market's going higher, they don't even care. They use any kind of little dip in the market to buy more. That usually has a bad ending. The problem is when I say something like that, and I know I'm right, but where you're wrong is it never seems to happen as soon as you expect it to happen. This is like Rick Santelli was on the other day, and you could see that people were mad. People were mad because the market didn't go down because of the geopolitical news. And you can sit there. They obviously, instead of looking at market-generated information, they obviously went in and shorted the market, knowing it was a non-brainer because there was bad news. The market was going to sell off, and the market didn't sell off, didn't accommodate. So they were mad. And that's the frustration that goes on. And that's why I wrote the other day, if you get the reports, rely on market-generated information, not on the news. Okay, let's take 3 more questions, and then we'll call it a morning.
Okay, sir, thank you. Early yesterday afternoon, another Brit trader who's in the intensive. Early yesterday afternoon, he thought that the high would be taken towards the end of yesterday. I thought we would have maybe seen the market go higher as value was higher, and late in the day when we got the high, I thought the shorts would have to turn and and start covering. Can you comment on that thought?
Sure. Confidence is very low. One of the things you look at,
can you show that profile? Excuse me, Jim. Just while you're talking, just have it up. You can cancel the split that you have. Yeah, thank you.
Okay. Confidence is very low. However, another reason we kept coming back into the previous day's range. And the fatter this point of control is, as we got in the close, it was quite fat. Even if you take out the last two periods, it was very fight. Even without the last two periods, point of control is actually down in here at the time. The fatter the point of control, the harder it is to get away from it. And trading it to get this short on the close, I understand that happens quite often, but that's a very high risk trade. The amount that you can make is very small for the potential risk that you have. And the market kept coming back into the previous day's range, sign of low confidence from the morning, and that's what happened yesterday afternoon. It's a very poor trade, even though I know very often you will see that run late in the day. They cover them right on the close. They didn't do that yesterday. But it was low confidence and had been back and forth into the previous days many times, which indicates low confidence. Okay? So again, it's a question of when it didn't happen. It was a question, I think, of what you wanted to have happen versus objectively looking at market-generated information and saying, it may happen, but the odds aren't real good. So it's a question of so many times I use the term managing your own expectations, which is key. And so many times the expectations, you wanted it to go, you've seen it do that in the past and think that's a neat little trade, but yet the market-generated information was saying confidence was low, point of control was down in here. The fatter the point of control, the harder it is to get away from it.
Right,
okay.
And it had just gotten so long. Okay, can we ask a question, or we're over?
Two more.
Can you show today's profile, Jim? Maybe cancel that split on yesterday's. I can see value building higher today, but my ruling reason for a change is if it gets back to half back, then something has changed and sellers are in. Would Jim agree?
Half back to what?
He's saying if it goes below half back, he's using it as a fulcrum to indicate change. I said he might be leaning on that a little too heavy. That it's
I think so. That's not the ruling reason. Yeah.
Yeah, we're still in range, and yeah.
Remember what I wrote this morning, and you got the report. If there's any change other than liquidation, you get down below the 1931 level, get down below the 1931, and start to accelerate. Small change if you get down below here. To get any major change, you've got to get below yesterday's low. So right now, all you've got is a very, very narrow, low confidence trading range as the market awaits the Fed. The only people you're going to have in this market this morning are, short-term traders. Longer-term traders, they've either already taken their position or they don't really care. Okay, last question.
Yes, I guess it's just really what you were just saying, that,
But what you said, Julia, counting on this half back from this morning,
it's the middle of range.
That's the middle of the range. I wouldn't worry about that. It's this narrow base. The narrow base is what is important this morning. If there's anything on the downside, you get a double distribution day to the downside. You leave these single prints, and you really start to accelerate down below the overnight low, down below the 1931 level, which was this area from yesterday. Unless you get down here, you have no real change. Okay?
Yes, and that's just for our last question. It seems to fit. At what level or condition will Jim trade a market liquidation scenario? And clearly he wrote in the report outside of that upper distribution. But It's also important, I just want to mention this, Jim, just to everyone, that how a market makes a low or a high. Does it take it out with conviction and confidence and go through it with volume, or is it just listlessly going? I mean, that's why Jim is always telling us to be so absorbed in the market and see how a high is made or a low is made. That has a lot to do with what we can expect or the odds going forward. And that's
Absolutely.
it, Jim. So where
When
would
you
you
look at this
consider a
market,
liquidation scenario?
this market came right down to the opening again. You know, mechanical. It's just mechanical. I don't know what I do. It depends on what happened. You know, if I got a breakdown below here, I might go with it. But,
Right, it might be a double distribution day, and there you have it. It finally has got it decided where it wants to go. But how does it happen? You know.
That's exactly right, and you don't know until you get there.
But you can put the trade on, right? And if it comes back in, you always tell us if it doesn't, you want to see it hold a double distribution. So if it did break below the A period low, we would want to see it hold that A period low and not come back up there, because that would suggest that the market doesn't have the, you know, the conviction.
Any staying power.
Any staying power, yeah. And it's just more low confidence to get whipped up in.
Now, historically what has happened, as soon as we get off the call, the market does something meaningful. Get ready.
Yeah, so we have to get off for it to make something happen.
Remember, those of you that are already clients, and you're a client if you have purchased a DVD set in the past, you have purchased the daily report,
Gone to a seminar, been in an intensive, you're invited to this afternoon.
Or are already enrolled in the intensive that starts in July, and we've had really phenomenal response to the July intensive. This is the fourth, I think this is the fourth seminar we've done, free seminar, obviously to help you understand what we do and to promote that intensive. There's one more next week. We'll review everything. But there is a client appreciation seminar this afternoon. We're going to be discussing trade that took place on June 12th, which I thought was a very important day, one of those days that can get traders in a lot of trouble. Also, it wasn't a 45-degree angle, but one of the kind of action that leads to the 45-degree angle that tells you the market, in this case, was too short. But anyhow, so if you are a client, that takes place this afternoon. And if you haven't signed up for the intensive, we would love more participation. It's been very good so far. Remember, as soon as you sign up for the intensive, you immediately start to get the daily reports. So once again, I thank you very much. Julia thanks you, and you all have a good trading day. Bye now.
And thank you, Jim. Everyone is thanking you, and we appreciate you sharing all your information and your experience and wisdom. So thank you very much. Everyone, thank you for being here. Fabulous participation, and great to have you. We will have this recording uploaded to the site in probably an hour or so. Okay? Thanks very much. Bye-bye.